Okay, well, I think we might make a start then. My name is Tony Barbone. I'm one of the directors of Private Mortgages Australia, and I'm going to be chatting to you all about some very exciting news that we've just released our new private lending solutions. So we're going to be doing a deep dive into our private lending solutions today. So let's, without further ado, let's jump on in and let's get into it. Okay, so today's session, we want to be talking about our new solutions that we're offering. We have our lending process that we're going to be going through. We have a case study there. We've got a very special guest who's going to be joining us today, Shanta Lobo, who is our General Manager of Relationships, and she's going to be walking you through our fees and charges, our lending process, fees and charges, and referral rewards. So that's very exciting. And I'm going to be finishing off talking a little bit more about the PMA way. So the private lending industry is very fragmented. Not all private lenders are created equally. And we're going to be talking a little bit more about how we differ from others that are out in the marketplace. So let's jump on into it. So why did we make a big shift over to providing new solutions? Well, I've been doing private lending since 2009, and PMA has been up and running since 2014. In that time, we've seen the industry change quite a lot, and we've seen, I suppose, as lenders, we've sort of we've gravitated towards certain areas of the market and away from other areas of the market. So we know what we're good at doing, and we decide to leave the rest. We leave the rest to the other guys. And I'll just use a bit of an example. So when I first got started in the industry, I was working for another private lender that specialized in caveat lending. Okay, so you probably think, what's caveat lending? Well, caveat lending is what I call the pointy end of the market. It's not uncommon to have interest rates at 3, 4, 5, 6% per calendar month, but for very short periods of time, usually just sort of 1, 2, 3 months, and they're usually done in sort of 24 hours, 24 to 48 hours. So when PMA first was established in 2014, we did caveat loans, but then we decided that that space isn't for us. So we've sort of gravitated to a very different area of the private lending market. We've decided to leave that very specialized area to the 24-hour guys. That's not us. We don't move that quickly. There are 24-hour guys out there that, and some of them are better than others. So yeah, just as an example, we know what we're good at. We're going to be diving into those solutions today, and we've decided to leave the other parts of the private lending industry to the other guys. So, let's talk a little bit more about private lenders, okay, and where we do fit into the market. Well, I suppose I look at the lending landscape in Australia. It really falls into two camps. So we've got the traditional lenders and we've got private lenders. Okay, so the traditional lender camp, I say that it is comprises of big banks, little banks, non-banks, credit unions, all of them. Those institutions, I would put them into the traditional lender camp. Okay, and private lenders are sort of comprise of everyone else, those non-traditional types of lenders. Now, in terms of a really good way to look at it is looking at where the funding sources come from. These traditional lenders, they have these securitization warehouses. They go off and they raise hundreds of millions, sometimes billions of dollars from international wholesale markets, and they're raising money at very, very low interest rates, as low as 1%, 2%, that type of thing. That's very, very different to private lenders, and where private lenders source their capital from. Private lenders source their investment from mainly self-funded retirees with self-managed super funds. That is really the backbone of the private lenders' investment source. And so those investors, they want their pound of flesh, and they have a higher expectation of a return. So that is really sort of the difference between sort of what I'll call the traditional lenders and the private lenders. So private lenders can't compete on price like traditional lenders. Okay, so that's why our focus as private lenders to really just sort of niche down into those areas of the market that we do really, really well, and we can provide really good value to our borrowers and our referrers, and we just want to really let the other guys focus on all the other stuff that they do really well. So what we've done is we've distilled our solutions down into two main camps. So we've got property solutions and business solutions. So let's take a look at those. So our solutions overview: property solutions, business solutions. So we are going to drill down into each one of these different solutions in more detail. I'm going to and do a little bit of a deep dive. So this is just very high level, but I wanted you to sort of see where it sort of fits into the overall picture. One of the other things, before we go too much further, I just want to, one more differentiating point between traditional lenders and private lenders is probably the main thing is that traditional lenders look primarily, first and foremost, at a borrower's servicing ability to service a loan, and then they look at the value of an asset, whereas private lenders look primarily at the value of the asset, the loan-to-value ratio, and the exit strategy. Okay, whereas traditional lenders are going to be looking at funding loans for sort of 25, 30 years, and they want to make sure that the borrower has the servicing capacity to do that. Private lenders are providing solutions for short periods of time, usually 3 to 12 months. So, we really want to make sure that the borrower has a contemplated exit strategy, how they're intending to pay the loan out in that short period of time. Okay, so back to our different solutions. So we've got property solutions, business solutions. Let's jump into each of these and we'll talk a little bit more about them. So our first property solution is our urgent settlement saver. And then what you're going to see a bit of an ongoing theme through the different solutions that we have. Usually something happens. Okay, so a borrower, and in this situation, an urgent settlement saver, we've seen this time and time again over the years. A borrower has gone off and they've put a contract on a property. They put down a deposit, 5, 10%, could be 20%, who knows? But usually there's 5 or 10% deposit that has been paid. It could be that they're a developer and maybe they've purchased the property on an extended contract, maybe 6 or 12-month period of time to settle. And in that time, they've gone off and they've gone through council and they're getting a development approval through council. Maybe it's not approved yet, and maybe they've spent countless hours and hundreds or thousands and thousands of dollars on getting that approval through council. And then they're expecting their bank to come to the table, and then something happens like COVID-19, and all of a sudden the banks are retreating heavily from these more from these sort of non-conforming parts of the market. So something's happened, and they need a solution. So they usually get in contact with their broker and say, "I need to settle next week. What can you do for me?" So that's where PMA comes into play with our urgent settlement saver. Now, if it's the actual intended property is going to be secured by a first mortgage, we can help. So we're looking at for intending development sites or land with might have improvements on it, but intending to be demolished, will only go as high as 65% loan to value ratio. Whereas if it's a property that has improvements and it's tenantable or it can be occupied, we'll look at going up to 70% of the as-is value on the security property. Okay. Now the name of the game is speed here, and so that's why we sort of put a bit of a firm limit on 3 million for development sites and up to 10 million on properties with improvements. But the rates are sort of 8.95 to 12.95% per annum. Now we're going to talk a little bit more about the overarching components of all of our different solutions. So we will get to that a little bit later on when we sort of talk about how we arrive at those rates. Our next property solution is core construction. So this is where the developer wants to actually build a project. Okay, so for us, we've found that our sweet spot is really helping those up and coming developers. Is probably a good way to describe them. Maybe they've done 1 or 2 projects and they're growing. They're sort of taking on larger size projects as they go. And in the world, or in sort of the traditional lender world, if they've got a bit of a magic number. So if it's a 4 or less of something, say it's like 4 townhouses or 4 units, it tends to be dealt with by one department. And that department is like the domestic residential department. And the first thing that department does is they look at the borrower's serviceability. Can that borrower take on the additional debt load to do the project? Okay. Now, if they're a budding developer, maybe they have lumpy cash flow, maybe they can't demonstrate servicing to that traditional lender standards. So, but they still have a viable project here, and they just need a way to move that thing forward. So this is where our core construction solution comes in. So it's for first mortgages up to $3 million, and we're lending on the as if complete value of the project. So, and to a maximum of 65% of the end value. Okay, our rates are 8.45 to 10.45% per annum, plus a line fee of 2.5%. Now, the way core construction works is that, we don't advance all of the money at once. It's done progressively over a period of time, usually 12 months or longer. And it might be, and we start off with $100,000 in the first month, and then another $100,000, and so on and so forth. So the line fee is really there. It's charged, the overall facility is charged on the line fee on the undrawn component. And then when the facility is drawn down, then the additional drawn margin kicks in, and that's when you end up. So the overall loan isn't charged at 12% per annum. It's charged progressively. Okay, so that's just the big takeaway I want to say for the core construction. It's done progressively. Now I've sort of touched on it already, but what I want to do is I want to just make a main point here is that. We've found over the years that we tend to service three main types of clients, or three main types of borrowers. So the first one is property developers, and our property solutions are tailored to them. The other one is property investors, okay? And the third one is business owners. So these are the three main types of borrower profiles that we service. So we're going to be we're talking about the property solutions here, which are mainly for developer and investor borrower profiles, and we'll get to the other part of which is the business borrower profiles when we move on to the business solutions. So construction support. Now this is for another solution that we've made for developers. Now this is where a developer, they've gone off, they've got a project that's shovel ready, they've gone through planning, they're ready to go, they've gone off they've got a builder lined up, they've actually been able to get finance from a traditional lender, but the problem is the traditional lender won't lend them to a high enough loan to value ratio. They just won't give them enough cash to be able to move them forward with the project. So if this is the case, we can, and as long as the first mortgagee is a traditional lender, not another private lender, we can help. Okay, so this is where we provide construction support. So we secure our solution, our loan, by way of a second mortgage on the project, and we can do up to $2 million, okay? And in the same situation where we're lending on the as-if complete value of the project, up to 65% of it, and our rates here are 18.95 to 22.95% per annum, and that's because there's additional risk with having to sit second place on a project behind a traditional lender, and when you are subject to development construction risk, okay? So our solutions have factored in that additional risk. Okay, so the next property solution we have is completion support. So this is where the developer, they've got a project, it's underway, they've been developing it for quite some time, they're using a traditional lender providing the finance, and then something happens. There's usually a cost overrun, there's a cost blowout, something unexpected. The builder can't move forward. The traditional lender providing the first mortgage, they aren't prepared to put in any additional cash into the project until it gets to the next sort of milestone or the next hurdle. So usually in this situation, it's a lot closer to the end of the project. Usually these are sort of 3 to 6 months away from the completion of the project. And that's where we can come in and we can actually secure our solution by way of a second mortgage over the project. And we can provide that additional cash needed just to get over that hurdle and move them closer and closer to completion. So this is up to $2 million loan amount. We can do, we're lending on the as-if complete value of the property, of the project, 65%, and we've got rates from 20 to 20.95 to 23.95. As you can see, they're a little bit higher than the previous solution, which was construction support, and that's because it's a different risk proposition when you're coming into a project and something's gone wrong and we're a little bit late to the party. So, we are factoring in that risk when we are quoting on these types of completion support solutions. The final property solution that we have is residual stock. And if you think about it, it makes sense. We've got a solution that helps developers pretty much in every part of the actual life cycle of a project. We go help them acquire the land, and then we can either construct it provide the core construction, or we can provide the construction support. Or if there's a problem, we can come in late to the party and help finish off the project. And of course, once the project is finished, then, sometimes, especially in the current environment where pre-sales are a little bit harder to come by, we can help them with a residual stock facility where we can pay out the existing financier who's funded the project. Okay, so usually what happens is that the types of borrower profiles that we're dealing with is that these developers have lumpy cash flow, especially if they're just getting started as being full-time developers. They have lumpy cash flow. They don't have the serviceability. Yes, there is income coming in from the completed project. If it's, say, like a bunch of units, yes, there's going to be income coming through there. But the problem is that a traditional lender won't give the developer enough like a high enough LVR to allow them to get equity out of the project so they can put it into the next project. Okay, so for developers, you've got, for them, they've got to keep things moving. So they've always got to be kind of moving on to the next project. So this is a way for them to, if they haven't had the ability to sell down a project because of the market conditions, it gives them the ability to extract some of the equity in order to move things forward. So secured by a first mortgage up to 10 million, and we're lending on the as-is value of the property, of the completed project, to up to 70%, and our rates are 8.95 to 10.95. Okay, so our business solution number one, which is really an equity release for first mortgages. So this is where we're either refinancing out an existing traditional lender. They might need some additional cash out. And if you think about it in the world of COVID, it sort of makes sense. You've got a lot of businesses out there that are been maybe more affected than others. Maybe the business owner owns quite a few different properties. They've got a property portfolio that they've built up over time. They know that their business is going to come back online again soon when things return to normal, but they just need a bit to get them through this short-term hurdle. So they can't go to the traditional lender because they haven't got the serviceability, because maybe their business isn't turning over the same level it was 2 years ago. So they need a short-term solution to get them through, say, for the next 6 to 12 months. So in these situations, we can provide a solution up to $10 million based on the as-is value of the property, up to 70% if it's residential. And our rates are 8.95 to 12.95% per annum. Our next solution is equity release, second mortgage. And this is a very similar situation. They own a property or have a portfolio of properties, or have a genuine business purpose. Maybe they need to pay out an ATO debt, or maybe they just need working capital for their business. The traditional lender won't lend them the money, so we can provide a second mortgage sitting behind their existing traditional lender, and we can lend them up to $2 million, and it's up to 70% of the as-is value. The rates are 14.95 to 19.95, and if you look at that, that's actually the property solutions that use a second mortgage to secure the loan. They have the interest rate's a little bit higher, and that's factoring in that construction risk. Okay, so when we're lending on an as-is valuation, there's no construction risk. So that's why the interest rates are priced where they are for this solution. So these are the overarching factors that apply to all of the different solutions. As I've already mentioned, we don't look at serviceability. It's not required for us. We're not a traditional lender. It's not what we look at first and foremost. We look at the value of the asset, lending to a conservative LVR, and then we want to see an exit strategy that shows that the borrower has contemplated how they're going to pay the loan out within a relatively short period of time. We're not a traditional lender. We're not doing 25, 30-year mortgages. We're doing 3 to 12-month solutions. Okay, so all of our loans come with prepaid or capitalized interest, usually up to 12 months, and then we have extensions, and it just really depends on the situation. Sometimes we've seen as much as 24 monthly extensions for a loan we did last year, and sometimes there's only as many as 2 extensions. So that it just really depends on the situation. Our rates and LVRs are postcode dependent, so we use a process similar to Genworth Financial that have their different postcode categories. We use a similar methodology internally, and that allows us to risk rate each postcode in Australia, and then we lend accordingly into each different location. Now, the pricing that I've put forward for all of the solutions that we've covered today, now that's all based on major metro locations. We will consider providing solutions in all other postcodes, but we might have a lower loan to value ratio, or we might have a slight risk adjustment in the interest rate. Okay. Now, all of our solutions, we can do them within as little as 5 days, and that's upon receipt of all outstanding information. The critical thing is, working with a cooperative borrower and a great referrer really helps speed up that process. We can only move as fast as the information arrives and we can go through it. So if we've got someone who's organized, obviously things are going to move along quicker. Where things might take a bit longer than 5 days is if it's a construction, we're doing a core construction type of solution, and we need to wait for things like a quantity surveyor report and evaluation report. These types of in-depth reports do take a bit more time. So, but once we've got our ducks lined up, we can settle very rapidly. So we're going to just have a quick look at a case study. So this one is one that we completed, I think it was about a year ago now. So this was an equity release first mortgage. So we had a developer borrower that we've known for some time. We're working on a retirement village in a regional New South Wales, in regional New South Wales. The first mortgagee and the second mortgagee were about to foreclose on the project because there were some fires and there were some delays, and anyway, the first the mortgagees were at the end of their tether, and they were going to appoint a receiver. So they basically said, we need help. We need to move. We need to get some money to these guys, these lenders, as soon as possible. Otherwise, we're going to lose the project. All of the time, effort, energy, all of the upside and profits down the road, we're going to lose. So we said, look, it's going to take us a little while to go out there and get a valuation and a quantity surveyor report done on the project. Have you got any other assets that you can work with? I go, well, actually, yeah, I've got an unencumbered property in Bondi Beach worth $6 million. And we're like, well, that'll do it. So we put a first mortgage on there at 33% LVR, interest rate at 9.75% per annum, and it was 3 months prepaid with 3 monthly extensions. We settled that within 5 days. Okay. Now, I just want to make a point on the interest rate here is that the interest rate is very much dependent on the location of the security property, the LVR, and the term of the loan. It's quite an in-depth process that we go through behind the scenes with our quoting. But basically, if this loan had like a 12-month prepaid loan term, it would be our base rate of 8.95% per annum. Okay, just so there are little shifts in the interest rate based on how long the loan is borrowed for. Now, what I'm going to do is I'm going to hand you over now to Shanta Lobo. She's our General Manager of Relationships. Shanta's on the coalface. She's out there quoting all of our new transactions. So you are in good hands for Shanta to walk you through our lending process. So without further ado, Shanta, if you want to jump in and take it away.
Hi, everybody. So I'll take you through the next 3 slides, lending process, fees and charges, and working with referrers. Our lending process is very streamlined. It has minimum number of steps, as you can see. Initially, the first step is for us to actually receive a quick app form, which is our application form. This is an online form, and unlike traditional banks' application forms, this is a very basic form. I've actually filled one up myself to see how long it would take, and putting in a dummy application, thinking of making up names of streets, etc. I still could finish it within about 8 minutes. So definitely less than 10 minutes to complete one of these. Once this is completed and comes through to us, it takes, we look at it initially. If we are interested, we will contact you within the next couple of hours. And if all goes to plan and there is sufficient information, we will issue an indicative letter of offer. On the other hand, if we are interested but there is not sufficient information, we can still issue a loan quote. which specifies the basic interest, the indicative interest rate, fees and charges, etc. But we will then wait for the referrer to provide us with other information that we can then go to an indicative letter of offer. However, if it so happens that this opportunity is not suitable for us, then we will have the discussion with the referrer and see how we can help. Now, one thing about this quick app form, it needs to be completed by the referrer, not the actual borrower. We don't need the borrower's signature. We are not doing a credit check at this point. So this is a huge benefit and to the referrer, who doesn't need to actually go get that signature from the client. Now, in terms of the indicative letter of offer or the loan quote, if the client is interested in proceeding, they sign the indicative letter of offer and pay our assessment fee. Then we commence our due diligence. So up to this point, we have not done any credit checks. We have not done any due diligence. The indicative letter of offer has been issued completely based on the information provided by the referrer. In regards to the due diligence, this is also a very streamlined process. We issue an application called File Invite, which is a web-based application which goes out both to the referrer and to the client in order to collect all the information required for due diligence. So both the broker and the client can upload all the information into File Invite. They can continuously see what they have, what other information is outstanding. If the information they have provided to us is good and we don't need anything further, we provide that feedback. If we need anything further, we also provide that feedback. So both the referrer and the client is kept up to date at all points. At this stage of due diligence, we also complete the valuation. Now, for valuation, we use external valuation companies. The client pays the valuation fees at cost. We make no money out of this. If the due diligence valuation all stacks up, we then move on to issuing the formal letter of offer. Once the client accepts the formal letter of offer, they are then liable to pay us the approval fee. Now, this is a big advantage in comparison to many of our other peers. Initially, they have paid us a very nominal assessment fee if they have accepted our indicative letter of offer, and I'll complete that fee shortly. And no other fees except the valuation fee, which is paid to the valuer. The next lot of fees is the approval fee, and usually this fee is deducted from the loan amount at settlement. So once we receive the letter of offer, client accepts the letter of offer, we then instruct our external solicitor partners to complete the mortgage documents. The mortgage documents are prepared by the solicitors and emailed to the client solicitors. One thing to note here is that the client will need to engage a solicitor or a lawyer, not a conveyancer, because the client will require independent legal advice. So once the documents are prepared and issued to the client solicitor, the client goes in, meets the solicitor, signs the documents, and we are ready to go to settlement. So the next slide is for our fees and charges. Going back to those two processes of indicative letter of offer and letter of offer, where I mentioned the assessment fee and approval fee, this is where I covered the details of that. So our approval fee is on a sliding scale. So between $100,000 and $500,000, we charge a 3.5% plus GST approval fee. Of this, we share 1% plus GST with the referrer. As you can see, going down the chart, between 500,000 and 1 million, it is 3% plus GST, of which we share 1% plus GST with the referrer. $1 million to $2 million, it is 2.75 plus GST, of which we share 0.75 plus GST with the referrer. Between $2 million and $5 million, it's 2% plus GST, of which we share 0.5 plus GST with the referrer. Between $5 million and $10 million, it's 1.5% plus GST approval fee, of which we share 0.5 plus GST with the referrer. Now, we don't have any monthly ongoing fees or management fees, so approval fee is charged if the client accepts our approval letter, not before that. The next fee is the assessment fee. This is between $550 to $770, inclusive of GST. This is charged initially if the client accepts our indicative letter of offer. Now, it's very important to note that I'm emphasizing on the if. That is, the referrer can communicate with us and provide us and submit a quick app form with us. We will do all the work. We will, if we are interested in the opportunity, we will issue that indicative letter of offer. But the referrer and the client might not be interested in proceeding with it. They have not paid, till that point, they have not paid us $1. So it doesn't cost a referrer anything to run an opportunity by us, unlike a lot of our peers who take a lot of funds upfront. If the client accepts our indicative letter of offer, then the assessment fee is payable. Then we complete our due diligence. We issue our letter of offer. If the client accepts our letter of offer, then the approval fee is payable. So it is really important that one acknowledges the fact that we are charging fees if we deliver a service. Our valuation and QS fees are at cost. We don't, again, make any money out of this. Our legal fees are at cost. We do not make any money out of this. Now, in regards to the referrer fee, which I've gone through the chart, on top of this, a referrer could also charge the client a service fee plus GST. Now, if they charge up to 1% plus GST, we don't need to cite any mandate. But if it is above that 1%, then we require to cite a signed mandate. If a referrer doesn't have their own mandate form, one can get that from our website. It is under resources in the tab. Last but not least is the fact that our referral fee is channel agnostic. What we mean by that is more than 90% of our opportunities come from referrers, and we would like to keep it that way. So the fees and costs are not any less if the client comes to us directly. In fact, when a referrer is helping a client, collecting information is far more efficient than if a client comes to us directly. So we really like doing business with referrers. Therefore, if a client that has been introduced by a referrer to us later on comes to us directly, we will still pay the referrer fee, despite the fact that they may not have been involved in the transaction. Go on to the next slide, which is working with referrers. So this I touched upon a little earlier, is the referrer service fee up to 1% or mandate client directly. So on top of the referrer fee, we are willing to, we can also include a service fee for the client. If it is up to 1% plus GST, we do not need to cite a mandate, but if it is more than that, we will require to cite a signed mandate. Now, the referrer fee is undisclosed to the client. However, the service fee will be disclosed to the client in both our indicative letter of offer and in our letter of offer. Both the referrer fee and the service fee is payable at settlement within 24 hours of settlement or the next business day, and there is no clawback. Subsequent referral fee are paid even if client comes directly. So again, I touched upon this earlier, that sometimes it happens that the client has been introduced to us by a referrer. However, subsequently for their next project, etc., they have approached us directly. But if that happens, even in that case, we will pay the referrer our referral fee. Now, the very exciting referrer rewards program. So we pay a referrer gift cards for, this is over and above the referrer fee or the service fee. This is a way for us to say thank you for supporting us and for your continued support. So I will go through this very briefly because it's quite extensive. If you are, if you wish, you can have a look at our referral reward program on our website. You'll find the information under referrers tag. But just to give you an idea how it works, say the loan is for 500,000. After we have settled it, we send out a gift card for $250. If the loan amount is 1 million, we send out a gift card for 500, $2,750, and 3 million is $1,000 gift card. Once a referrer hits $3 million lending to us, they then qualify to become lifetime members of our Platinum Playground. What that means is for every $100,000 written subsequently, we provide a $100 gift card. And again, this is just a way of saying thank you to our referrers and supporters. I'll hand it back to Tony. Thank you all for your time.
Thanks, Shanta. Much appreciated. So, yeah, you've got a good idea on what it is to work with PMA and how to be remunerated. So let's have a quick chat about the PMA way. Now, I'm mindful of time. We've gone a little bit over, so I will just, you can read those ones. But what I want to do is I just want to talk about, which Shanta's already touched on, I just want to talk about what some of the other private lenders out there in the space do, some of the tricks up their sleeve. So what we stand by the fact that we have no charging clause in our indicative letter of offer and no cancellation fees in our indicative letter of offer. We've seen other lenders out there, private lenders out there, and they have charging clauses and cancellation fees in their indicative letter of offer with the from rate. So I'll just give you an example. So we've seen an offer like this go out a little while back where the indicative letter of offer said interest rate from 1% per calendar month. The borrower signed off on it. The private lender did all their work. They instructed their solicitor. The loan documentation went out from the private lender's solicitor, and the interest rate on the loan documents was 4% per calendar month. And the borrower was like, what's going on here? I was expecting 1%. It's come back at 4%. And they're like, yeah, that's right. And if you withdraw now, we're actually going to hold your property to ransom until we get paid our cancellation fee. So they're kind of like damned if they do and damned if they don't. So a lot of the time that's how some of these private lenders win the business, is by kind of coercing someone into taking the loan. So we call that a dirty loan. And I suppose really PMA, the whole ethos behind PMA was to set up a business that with the belief that our ethos is cleaner loans for better results. You know, we're all about operating a transparent business. And I suppose one of the big takeaways from that is that we get a lot of repeat business from our borrowers. They come back again and again, and we are regularly paying referrers for introducing the borrower to us, and they get paid again and again. Even though for subsequent loans, we sort of take the whole process from start to finish and just call up the referrer and say, send us an invoice. So that's something that we pride ourselves in. It's the reason why we get a lot of repeat business. So that's probably the big takeaway I wanted to sort of just have a chat to you about today. Look, we have sort of run a little bit over. Just to let you know, let's have a look here. I tell you what, we just because we have gone over time, I won't have the ability to go into all of the questions that have come through. So look, if you do have a question, if you could jot down Shanta's details, send Shanta an email, or if you could give Shanta a call, she's happy to help. Spitball a scenario if you have one, and she'll be able to field any of those queries that you have. So look, thank you all for your time. We really do appreciate you taking the time out of your day. We're going to be sending you through a CPD point for attending today. You're also going to get our updated referrer pack, so stay tuned for that. We're very proud to be releasing that today. Thank you all for your time.